Why don't you tell us a little bit more about yourself, your background, and yeah, what brought you into crypto and led you to start Symphony and Orchestra Lab?
Sure. I've got a background in AI, more accurately adaptive AI, that I've not really been able to use. And with the next couple steps, though, I am planning on using it there. One for an AI wallet and the other for an AI neobank. So those will be good to have. And this creates the financial rails that's necessary for that. There wasn't really anything that had the functionality that I needed for those, so built that first. With that, I've got a little over 10 years of experience in software engineering, and most of that is in web development. So I was able to build out a lot of the front end for this, and originally did the original blockchain implementation of this in Golang, base Golang, which no one really wants to work with because they all like their frameworks. So oh well. Like what I did for research for that was essentially trying to figure out if an adaptive AI was possible and what would be necessary for that. Essentially, with the implementation that I came up with, it required a multi-level system in order for it to essentially have a layer that reevaluates the action layer and then retrains it as needed. So what that was based off of was the psychological principles of learning. There are those 4 stages of learning. There's basically like conscious learning, conscious mastery, and then unconscious learning, unconscious mastery. And you try to move through those stages as you go, and you can fall back depending on whether or not you're making errors. So that was trying to re-implement that for AI, so that way it could actively learn and retrain itself and re-implement the new process that it's learned.
Wow, makes sense. A lot of technical stuff. So you have a technical background, and eventually that led you to crypto, which is very fascinating. And like these days, stablecoins are like the hot topic. Everybody is talking about it. There are different flavors of stablecoins, like the centralized ones, more decentralized ones, algorithmic stablecoins, fully backed stablecoins. So with Symphony, you're building a Cosmos SDK chain, and like your catch title is the Stablecoin Chain. So yeah, what are the major properties of Symphony, and yeah, what kind of products do you envision to bring to Cosmos and the broader crypto industry?
Yeah, well, one way you could look at this is a forex because it works very, very well as a forex. And having an application specifically for that, so that way you could do leverage in forex, like you do in centralized markets, would be nice. So, ideas for people. With that, what we do is essentially we offer multi-currency stablecoins. Now we can offer stablecoins for anything. With this system, we can literally offer stablecoins for anything. We have them. We're going to start with roughly 5 different currencies, but one being a precious metal, gold. And we can just expand from there because the way that this works, it makes it fully expandable, is that you can have it the way this is implemented, which is fully adaptable, is allows us to have all 180 different currencies, all 10 precious metals, any other stock, bond, real estate asset that you want on there, and like there's even with stocks and futures, like they even have one for orange juice. I don't know why they have one specifically for orange juice, but they have that. And because they have that, we could literally put that on the chain, and you could be trading with people with orange juice. Like you could pay for your groceries or send money overseas with orange juice. I don't know why you would do that, but you could very literally do that with this because we can peg to value anything. A stable coin is, for most people, they refer to it at this point as dollars. It's not dollars. It's a coin that's pegged to a stable unit of value. So with that, we have stable coins for basically anything. We have a stable coin suite. So we are going to be starting with Chinese yuan, Russian ruble, the U.S. dollar as well, gold, and most likely the Indonesian rupiah. Because with offering those, we have very certain target markets that we can access. But most people, because they use U.S. dollars everywhere else for stable coins, will likely be using that one to start before they branch out into other things like gold. Like maybe you've seen the recent gold run up, or the Chinese yuan turning deflationary. Those are both reasons to switch over to those. And should you follow politics, maybe like what one country's doing, don't like what another's doing. You think that one country is going to do well with its currency, with its economy, so you change over to that one for a bit. And when you don't see that anymore, then you change over to another one. You could do that. That's entirely possible with this. And then with applications that you throw on top of that, like it's got native yield, so you can always add, you can always access that. You can multiply that with restakers. You could We've got them fully interchangeable. So like I said, you could do Forex, and they're gas compatible. So you don't even need to worry about the native coin for the transfers, because the gas is going to be taken directly out of the stablecoin anyway. And that is including with that interchangeability aspect. So we have all these things that these other chains are just starting to figure out are good things to have. Last year, they figured out that, okay, yield is good to have for stablecoin. Then roughly 6 months ago or so, they started to figure out, okay, gas compatibility is good for stablecoins. And now they're starting to figure out local currencies are good to have for stablecoins as well. So not just the US dollar. We have all of those things all together on one system. And yes, they've just recently figured out that having a chain for these things is good to have. So we have all these things on one system. It's taken us a little bit longer because it's literally just me funding it, but we have all these things all together that all of these experts are just figuring out are good to have. We do all of that. So,
all right.
like, short answer, we do all of it.
That's good. So let me just try to break it down. So you've built this stablecoin platform, but you go beyond stablecoins. And as you mentioned, like for us, stablecoins is always back to a dollar or just to some other fiat currency. But you said, or also on your website, it's written that you can peg this stablecoin to whatever, Forex, gold, or other, also real estate. So to me, that sounds a little bit like RWAs. So how does it work in the backend? Because like this stablecoin, it should track the value of gold or whatever it is, right? And there must or should be some collateral backing up the stablecoin. So yeah, how does this work on your side? And how do you maintain the peg?
Well, you know how USD1 operates?
USD1, I'm not sure. That's no, I know about, like usually they all are backed by US treasuries, but yeah, tell us more about USD1.
Oh, no, the collateral doesn't matter for this aspect. For the exchange rates, the way that USD1 operates, and that's Trump's stablecoin, the WorldCoin one, the one that people are worried about because it's the president getting into markets and backing his own company on that. Like that's literally the news point on it. It's like, should we be allowing this and all that stuff? Whether or not that should be allowed, whether or not like you agree with it or whatever. Trump's WorldCoin, USD1. This is the way that they do that. They're essentially using the same exchange mechanism that we are. There is one pool for collateral, and that backs the value of all of these different exchanged units. Now, to create the different units, you have exchange rates, and for each of those exchange rates, you take the base unit the base unit of value that you have, and then you use the exchange to say this much of that unit equates to this unit of value. At that point, you are no longer trading units; you're just trading value. So because of that, like using yen as an example, like roughly 10 years ago, and it's similar enough now. It was roughly 100 yen for a dollar. So going by that, if you were to spend $5 on eggs here, you would expect to spend roughly 500 yen on eggs there. If instead you're spending 1,000 yen on eggs over there, and you see that, and you check out the exchange, and then you're thinking, okay, this is much more expensive than back home. You don't like that. You don't like that value exchange for the eggs, so you buy it elsewhere. This is literally why people are going to China for a lot of things, because it's cheap. It's cheaper to get it from them than like with their supply chain, as opposed to getting it over here. It's very literally cheaper. Whether you're using U.S. dollars or Chinese yuan, it's cheaper. So that's why a lot of things are moving over there, or have moved over there for that, because it's not about the unit, and most people focus on the unit. It's about the value. Now, the unit of the dollar has declined in value over many years. A lot of people will talk about that. That's why that's the result of inflation. What people don't correlate is that dropping of value means that you are not valuing this unit as much. So it's not the unit you care about; it's the value that you care about. But then they look at stablecoins and they think, peg everything to the dollar. The dollar is king, dollar is great, and all that stuff. Like those two thoughts don't quite align because you have one, you're looking at the unit, the other, you're looking at the value. USD1, and the same way that we do things, is looking at the value. The value is what matters, not the unit. So we can denominate in anything, but what's transferring is the value. So using inches to centimeters as an example, if you care about measuring your desk, it doesn't matter if you measure it in inches or centimeters. What matters is how long it is. The unit does not matter. So that's how we're doing that. For the collateral, though, that's a separate thing. For the collateral, they use treasuries. Most stablecoins use treasuries, which I don't quite agree with, because treasuries, while well correlated to the dollar, are not the dollar. Those are backing the government. Those are government debt, and should inflation happen, should hyperinflation happen, bonds fall faster than bonds lose their value faster than the native unit, which means they are not the dollar. They are not the currency itself. Because if it was the currency itself, it would fall in line with the currency. So why in hyperinflation does the value of bonds drop so quickly? Because it's a promise of future currency. It's not the currency itself. So the problems inherent to collateral are inherent to treasuries as well. But that aside, we are like USD1 and most others will use treasuries. They will be beholden to the government. They will blacklist and do whatever the government tells them to because they rely on the government for their business model. We don't do that. We do things in a decentralized manner. Ours is more akin to MakerDAO than it is to USDC. We use an over-collateralized model, so we have 2 times the value of any of the total value of all stablecoins in the system. We keep double the collateral to that for value, but we also make sure that there is a circulating system to constantly refill that reserve. So even if this drops past 50%, everyone gets their value because at that point, what ends up happening is you're no longer backing by just 2 to 1. You're backing by more than 2 to 1. So should you need more than 2 to 1 collateral, should the value of the native coin fall, that will keep getting supplied by the fees on the chain. Panic creates more movement, which creates more fee generation, which refills the reserve, which allows for more of that collateral to be dispensed. That's the way that works. But we also don't need to worry about this is a complicated system. So there are 3 different parts here, 3 different main parts. So for the last one, because we talked about the exchange, we talked about the collateral. Here's that last bit. We unlike other decentralized stablecoins before us, we don't worry about price discovery because how do USDC and USDT work? Well, they take fees. Those fees go towards buying. New bonds. That's why you have a consistent cost on those for transfers. But they do have fees. They do take those to help make additional money. That's one of their revenue sources. And what they end up doing is with the back and forth of buying bonds and everything, throwing that into their accounts, they use their accounts as their source of information. Their accounts tell them, here's how much money we can print out into crypto. Well, that source of information is their oracle. We use oracles as well in the same manner. Our oracles tell us, here is the value relation of this unit of value to that unit of value. And that includes, which we talked about for the exchange bit, but that includes also our native coin. So if our native coin is worth this much and US dollars are worth that much, then once these 2 are correlated based off that exchange rate, we know keep double this amount. Should that fall, we know, okay, keep double this amount now. And that's when the fee generation kicks in to refill that reserve. So it's always making sure that there is a 2 to 1 backing at minimum in order to keep that. It's just a unit of value that's used to measure this.
So let me see if I understood it correctly. So the stablecoin is backed by your native coin as well as external collateral, right? So I suppose that crypto people or folks in the cosmos, they can deposit Atom, Osmo, whatever, Bitcoin, ETH into your pools to bring up the collateral, and then they can mint stablecoins against it. And your native coin comes in when there's some external pressure on the system, just to make sure that this ratio between collateral and minted stablecoins remains healthy, right?
What we're starting with is just the native currency, but the reason why we call it a crypto reserve and not a melody reserve is because that is the expansion plan. What we want is to keep a basket of currencies, not like Kujira, because again, the collateral doesn't matter. The collateral doesn't solve the problem, but specifically keeping those in order to allow people to escape into those should anything happen with the native coin, because with all the protections that you can put into place in any system for any security. For any security on any system, you can't protect against everything. Now we've both secured and tested this against up to 99% drops, which is good. We've ensured that with those tests, that is testing at 50% drops, 75, 80, and 99 for every single one of those. And every single one of those cases, it does bring up the collateral based off of Terra's crash data. It does bring up the collateral necessary in order to get double the backing of the collateral that they needed at the time of their crash. In every single one of these cases, and that was when they just dropped to 80%, when they just dropped 20% to 80%. So we can drop a lot farther. That's fully tested. But even if we're wrong on that, because even if there is some super rare case that is not considered, that is what that crypto reserve would be for. That's what the fiat reserve would be for. The reason why it's not necessary up front, though, is because it's essentially saying what the argument is here is everyone's saying how to measure a horse. The horse being the collateral requirement here. Everyone's saying how to measure a horse, and they're arguing whether to use inches or centimeters. The problem is not whether to use inches or centimeters here. The problem is that the horse is running. because when the horse is running, the panic in the market, when the horse is running, your little ruler isn't going to stick next to it. So you have one of two options. Either you stop the horse or you keep up with the horse. Now, MakerDAO and other systems, what they do is they do market halt. They stop the horse. So you get forced selling on MakerDAO as an example. Your position is forced sold. So you actualize that loss against your will. You actualize the loss. In our system, we have a circulating system, so that way it's always coming back into the reserve, and you always so that way you always get that value regardless of the drop. That's tested down to 90, like with a 99% drop down to 1% of original value, like I mentioned. So we are taking the approach not to stop the horse, but to keep up with the horse. The panic rebalances the system. So while we are going to get those in, including Atom reserves, Bitcoin reserves, and others, based off of various percents on each, based off of their own tokenomics. That is not something that we're going to have immediately, because with very, very limited funds, we can keep a super secure system, but it has to be very simple and very low cost to implement. So that's so this is the one that we're going with now. The initial 30,000 and potentially more are going to be out of my own funds, and that's not including the development funds. That's just towards the liquidity, and then we expand from there. So any realized losses, at least from the start, are going to be directly on me, and that include and because there's that starter amount, should things drop drastically, the person who's going to be losing the money is also going to be me, because I'm the first buyer, I'm the first one in, and the last one out, essentially, because I'm not going to be pulling that out. So that creates, So this creates a system where literally I'm the buy pressure for everyone else's selling, essentially. Should everyone else sell, I'm the buy pressure for that, because I'm the first in, last out.
All right, so you will provide the initial collateral, as I understood, those 30K, right? And what will be the first stable coins that you could mint against it? I saw that you were talking about USD and Euro. So are you starting off with those, or do you have any other coins in mind? And a follow-up question: if folks like us, we want to deposit additional collateral to mint some stable coins, how do we get that collateral in? Will you use IBC, or are you collaborating or looking into IBC Eureka that you could potentially also pull in Bitcoin or Ethereum as collateral, or also Solana in the future? So yeah, what's the general relationship with the broader Cosmos ecosystem to bring assets onto your exchange? And yeah, where does sorry for another question, then I will let you go, let you explain everything. Where does the liquidation happen? Does it happen on Symphony chain itself? Because as you mentioned, you have a built-in DEX as well. Or do you have planned to use ICA interchain accounts to liquidate on like deeper liquidity pools on Osmosis or on Stride potentially in the future? So yeah, just take it wherever you want.
Okay, so a good stablecoin is usable anywhere. So the end goal here is that we have this usable anywhere. There are multiple steps that are going to be taken towards that. One includes connecting Symphony to all the other chains. Another includes those aspects, like I mentioned before, like in the chat, and then also to other people of one, an AI multi-chain wallet. A multi-chain wallet is necessary. We're going to be adding an AI because I'm an AI researcher, and this is super easy in order to improve UX. And then also a neobank, because a neobank can connect to each of those, make sure that you have an off-ramp, make sure that you have a payment gateway into real-world payments, and then also I can add an AI just because that's a very easy way to improve UX. Not these AI things where like people use it to answer all your questions so they can fire people and not have to pay as much, but one where very literally you could say send $100 to mom. And because you already entered her bank account information there, or because you already have something like Zelle included on your bank, it knows who to send to, and it takes all the steps for you. So you don't need to sit there and click around for 5-10 different clicks, looking for the different screens or checking help in order to find out where you need to go to. You literally just tell the AI, hey, send this to this person, and it handles it for you. Super easy, great UX win. We could do that, and then and that'll allow us to access multi-chain through those portals, the wallet and the neobank. So those are very, very future. Very before then, like we would want to connect on opening access to Solana later on. The other is, and we are planning on connecting to Stride through them. The other is Osmosis and Polaris. Now, Osmosis uses Polaris, and Polaris already has access to Solana. So being able to access both of these DEXs, the Osmosis DEX and the Stride DEX, will allow us to access both of those areas for the largest areas of liquidity straight from the get-go. We're also planning on connecting to Babylon, though, because we have Bitcoin-style tokenomics, like a deflationary change to Bitcoin tokenomics, but we do have Bitcoin style tokenomics. So connecting to Babylon to get that Bitcoin type of security would also be good. So this would allow us to access three different sources of liquidity right there. Well, not liquidity itself. I don't remember. Three different large market cap ecosystems right there, very, very easily off the get-go, without very much additional development. So it's a low-cost way to access these different environments and get the stablecoins usable within those. Very low cost, very quick, very easy access. So this is very good for a company that is not funded, because we're not backed by large VCs. We're backed by me, like very directly me. Now, this allows for the community to get in sooner. This allows for us to do a seed sale later. So after we show the traction, after we show that traction and our growth, then we bring in investors. They come in on the seed stage to allow us to build out the neobank, and then we move on from there. And essentially, all those early backers are rewarded by the investor that comes in later, as well as our future growth. You can stay on the ride for as long as you want. Now, with that, being able to access those different ecosystems allows us to access different DEXs as well. For example, PancakeSwap and Uniswap, super large DEXs, both on Ethereum. Being able to access those would be nice. Being able to get our stablecoins into those would be nice. There are also other stablecoin chains, not stablecoin chains, but stablecoin exchanges out there, specifically stablecoin exchanges or stablecoin use features. We'd like to be able to access those, and those are on other systems. Before we can build them into Cosmos, we have to access them where they are. But end goal is to build them into Cosmos as well. We want to build out the Cosmos ecosystem. We want to make sure that things are accessible in the real world for Cosmos users and allow for access both on and off of this system. But to be able to get there, we need money. And since it's all backed by me, we have to take the lowest cost method first. So we're going with the lowest cost method first, and those are those. But you also asked about how the exchange works on our system. Now, I do keep relating things to Terra, because when people see that this is not a centralized chain, they immediately relate it to Terra. We're over collateralized, so we're closer to MakerDAO, but since people make the relation, I make the relation. Now, the way that Terra did things was they burned on one side and they minted on the other every single time. So they burnt Luna, they minted USDT, they burnt USDT, they minted Luna. They kept no reserve at all. Now, a lot of people think that they did because that would be the smart approach. They did not. They very literally just burned money and printed money on the other side every single time. This is why their system was so exploitable, on top of just having arbitrage. Like, very literally, it was only arbitrage, no other systems in place. So price discovery, arbitrage, and printing money all work together, so that way when there's panic, you fail. Now, we've removed all of those systems, but for the stablecoins themselves, if you take Melody and you put it into our system, that Melody goes into the reserve directly. Like, there is the 2-to-1 reserve. That Melody that you put in goes directly into the reserve. It is held.
So
you then get
the native coin of Symphony, I suppose, right? Just to clarify.
Yes. Yeah, I should have mentioned that. But Melody, our native coin, goes directly into that exchange and into that reserve. You then get the minted stablecoin. Now, the stablecoin has to be minted because it does not previously exist. So that value that you put in from the amount of Melody that you put in is then minted into a stablecoin. Great. Now, you have that, and over time, via fees on the system, the second backing is taken in. So this allows us to get the 2-to-1 backing. So instead of those fees lining our pockets, those fees go directly towards the reserve to back the reserve for that 2-to-1 backing. So so we're not making money off that the same way USDT and USDT do. The same way USDC and USDT do. We're immediately backing the reserve with it. So what this allows us to do, what this system allows us to do, is essentially you buy in at 1-to-1. This allows us to essentially keep up the MakerDAO style over collateralization while also keeping that centralized exchange low cost in place as well. So the way that the exchange works is via that, and then it also works the other way around. You sell the stablecoin into the exchange. You get that 1-to-1 backing of Melody back. The other backing on there, the one that was taken by fees, those fees are taken in Uphold the reserve. At that point, what you've essentially done is you've created an excess within the reserve, which allows us to keep over that minimum 2-to-1 backing. So this is that's why I keep saying 2-to-1 minimum, because we can go over that, and we can go over that very, very easily. But that's how it works on both sides. It very specifically utilizes a reserve, and then additionally fills that reserve, so that way it goes up to 2-to-1, while keeping things low cost, so that way it's accessible. Because who wants to buy double the price of something? Who wants to buy something at double the price? No one wants to do that. Everyone wants to buy it at price.
I mean, I still have some not mental issues, but it's hard for me to imagine how this all works, because like there's the collateral pool and then Melody comes in. And Melody, I mean, it should have some value in order to back all these stable coins. And as you said, for now, probably you raised a little seed round, but the token must be live the moment that you guys are launching your product. And right now you're in testnet. So, like, what is backing Melody and what is giving it its value in order to create lots of stable coins out of it? And like, how are you distributing these coins? Will there be a big float just at the get-go, or will you keep back some Melody to be issued later on? Because I think it's important to be like for Melody to have some value, to be widely distributed about the community so that it can, yeah, be used as collateral and support or prop up this entire system, right? So yeah, tell us a little bit more about the Melody token and its functioning in the Symphony ecosystem.
Yeah, that's the cold start problem. Now, the way that we're getting around the cold start problem is I'm supplying that initial money. Now, so here's a problem that I have with crypto, and this is something that I've had with this is an argument that I've had with people before. Now, what a lot of people do in crypto is they say, well, I want this valuation, so we're gonna price things at this, and I think that's where things are going to sell well, and we'll start from there. That makes no sense to me because you're pulling a price out of nowhere. Now, what we're doing, and that would be where the cold start problem would come in. If we were to create a price out of nowhere and say it just has this value, then that would make no sense. What we're doing instead is I'm buying that money. I'm putting in this amount of money directly into liquidity in order to back this amount of coins. You want to mint stable coins, you can do it by having that amount of coins and sending it into stable coins. You're not going to be able to mint more than that unless you buy into the system and throw that in. Because for the amount that we are giving away, I am very specifically buying in for that amount and excess. So if you want to mint more than that, you are very literally going to have to buy Melody and mint the stablecoin off of that. How much of the stablecoin can you mint? Depends on how much of the stablecoin you bought. Depends on how much of the native coin you bought, because the amount of value that you've bought is going to go directly into the stablecoin once you mint it. Anything past that, you can't really do because where's that value going to come from? You don't have the coins if you don't buy the coins. For anyone that's getting the airdrop, their coins are backed by my money. Like, that's not coming out of nowhere. We're not just coming up with an arbitrary value. That value is coming out of my money directly, like directly out of my pocket. You got my money on that, like in your wallet when you get those. So you want to mint it into a stablecoin, into gold, or into a Bitcoin stablecoin or something like that. You want to do that, you can do it. It's going to be in direct relation to the amount of my money that you got. So there is no cold start problem at that point because I'm the one starting this up with my own money. Like, so who is that initial buyer? Where is that initial value coming from? From me, directly from me. So I throw in 30 to 40,000 based off the airdrop amounts go out, and that is directly tied to the amount of liquidity that I have put in. Anything past that, people will have to buy in because no one has those coins until people buy in outside of the ones that came in from the airdrop. Does that answer the question, or is there a piece that I missed there?
Helps a lot. Thanks. So you were talking about the airdrop to get the initial supply out there, and yeah, do you already know some airdrop criterias, or like to whom will this airdrop be distributed? And basically, this airdrop acts as an incentive, I think, to try out the Symphony chain ecosystem, to use those coins as collateral and probably mint some stables against it to just keep the initial, or to get the initial flow going. And yeah, that should also incentivize some initial trading. But at the other side, if most of the Melody coins end up as collateral, I mean, who or what secures the Symphony chain? Can you also stake your Melody and use it as collateral simultaneously, or are you considering external sources of security like Babylon as a Babylon secured network, or do you think about renting out security from the Cosmos hub? So yeah, how does the security aspect of the Symphony chain play into this?
Well, we wanted to connect to Babylon, get the Bitcoin security from there, but that really depends on ensuring that it doesn't negatively affect the tokenomics of the system. Now, one thing that is good about this is that we do have maximum cap. Now, any of the safeguards that we have would have stopped the terror problem. Like, any single one, having a 2-to-1 backing, like, or having a reserve at all, literally would have stopped it. But more specifically, having a maximum cap would have stopped it. We have maximum cap as well. Like, and then also the Oracle protections, because we've got information cleaning on there as well. But like, so that stops issues like what USDC had with Silicon Valley Bank. But whatever. With maximum cap, we essentially have Bitcoin style tokenomics. So we have maximum cap. We've got halving events. We've got a bit of money that comes in via the staking. So like rewards from that, which again, I'm backing the system with my own money. So don't worry about that. With the maximum cap though, here's where that works, and here's why this is good for both bull and bear markets. Granted, it's still better for bull markets because everything is better for bull markets, but why it's good for both. One, we've got the stable coins for the bear market, so you can cash out of Melody and go into the stable coins for the bear market. What that does is that contracts the supply of Melody on a 2-to-1 relation of your value. So however much you put into the stable coins, double that amount is going to get sucked out of the circulating supply and is going to go directly into the reserve. That's going to constrict that maximum. Well, wow, why can I not say this? It's going to restrict the maximum supply down a bit, depending on the amount that the stablecoins are used, which is naturally going to be used more within the bear market. So there's going to be more constriction there. In the bull markets, though, you probably want something to speculate on, whether that is Bitcoin or an altcoin, and that is where the native price comes in. And as that native price goes up, congratulations, the reserve is more fully backed. Now, what ends up happening there is now some people want to keep a little bit of money extra. Some people want to just hold in stable coins because they feel it's more secure. Some people want to wait for some special event, and in any of those cases, any of those people are going to be in the stable coins, as well as people using it for things like remittances or everyday payments. So there's still going to be some stablecoin use, but people can always go into the native coin and ride that up on the bull market. But with the contracting supply, the more that the supply constricts, the more each individual Melody is worth, which means that the reserve value is going to go up relative to the amount of stablecoins out in space, and it's going to take less of the Melody itself to mint more of the stablecoin. So because it's on a direct value relation for what you put into what you get. So it benefits holders of Melody for more stablecoins to be used. One reason why we're making the neobank, and then it also benefits them to hold Melody and push out or to hold the stablecoin itself. Both gain yield, but the stablecoin does not affect governance. It's only Melody that does. So that there's more incentive to hold that.
But you
Melody also gets more of
Melody, right? Like you can stake it to validators, and there should be some inflation and probably also some protocol fees going to Melody stakers. That is generated.
Melody stakers also get larger amounts from staking than stablecoin stakers do, because we do want to incentivize holding that. That said, stablecoin stakers would still be getting very good yield because it's a new chain, and naturally on a new chain you get higher staking amounts. So because that's just.
Can we just double click on that? What do you mean by stablecoin stakers? Is it providing collateral for stablecoins to mint against, or what do you consider stablecoin stakers?
Now, it's not staking to a validator in that case. It is just staking towards the system, holding it in, so that way you get a portion of the rewards. This is very specifically to keep it outside of governance, but to make sure that it is still contributing to total value locked. Now, with that, there is a certain amount of the rewards that will go towards stablecoin stakers versus Melody stakers. And what ends up happening on that is half the rewards from the stablecoin staking goes directly towards the reserve, and the other half goes towards them. Now, in every single case of this, while we're talking about tokenomics, anytime someone new comes in, just want to re-mention this. I back the system with my own money. The amount of value for the chain itself is based off the amount of money that I put in initially, before considering anyone else buying in or selling. Now, with that, we have planned for me to put in enough money to back all of the airdrops and excess. This allows us to run for a couple of months without any issue, and I can always throw in a little bit extra if we need to go past that. Well, a couple of months should be good enough to get things up and running because we're going to be making connections and everything, but should we need to, I can always throw in extra as well. The point is, the system is backed by my money, so no need to worry about where the value comes from. With the rest of it, though, going back to the staking portion. Melody gets a certain amount, and then the stablecoin stakers get a certain amount. This is specifically to allow for stablecoin yield, to allow for people to want to hold those, to allow for total value locked to go up. And what ends up happening in those situations is what that also allows us to do is to court groups like NFTs, so that way and ask them to put and ask them to make their NFT sets yield bearing with us, so that way they can use those staking rewards to incentivize purchases of their NFT sets. We want to try to incentivize use of the chain as much as possible. We also want to incentivize total value locked. This requires use cases. This requires applications and other things like that. Which is why we're going to be making our multi-chain wallet and pushing our stablecoins on there. We're going to be making a neobank, pushing our stablecoins there, and we're going to make multiple applications and then and have our stablecoins usable in those as well. But each one of these takes time, takes steps, takes money, and all that stuff. So it will get very, very hefty very soon. But we'll go as far as we can.
Talking about timelines, and like we're slowly wrapping up the space. Thanks for coming on and sharing all these insights and explaining us what you guys are building at Symphony. So what can we expect? You're currently on testnet, like when mainnet, when Melody token launch? Yeah, what are the rough timelines? And of course, airdrops, as everybody in crypto is always keen to know when these things happen and if they might be considered as airdrop recipients, eligibility criteria, so on and so forth.
Well, we've got 3 airdrops planned, and the first one happens with the testnet. That data is going. That one is dependent upon testnet tasks with certain people eligible for that in order to prevent bots from getting any of the rewards. So that first one we call the task route. The second one we just called an airdrop because that one is basically just going towards members of various communities. That includes members of this community, members of NFT communities, members of various chains. Again, for staking certain amounts for the chain holders. Now, with that one we're not sure about the gating criteria. That one still needs to be planned out because it depends on whether or not OmniFlix is going to remain available for putting up information. At that point, it's going to be going through the videos to get the information so that we know what we're doing, and then getting the airdrop from that, or having a certain amount of MLD in wallet and being able to get it from that. One of the two. I prefer the OmniFlix one. I really want the OmniFlix one. As long as they remain open to us after we get onto mainnet, we're good on that. And then we have the last one, a fair drop, which rewards those that take actions on the chain, such as staking, in order to incentivize chain use, as well as incentivize. We also have a fourth one that's unannounced, but that one will be going through depending on what we get onto the chain. We do have the multi-chain AI wallet that's going to be coming, as well as the AI neobank that's going to be coming. And I did talk to one notable person within the Cosmos community just earlier today to try to build up a team for that so we can get funded. Because again, neobanks need a lot of funding, and that is more than I can provide. So hopefully we can get funding for that. Should we not, we're going to be building out apps instead. So we'll see where it goes. But that fourth one will be to incentivize use of that application, or it just really depends on what comes through. We can also throw in others for use of different systems that we connect to, which is why I mentioned creating yield-bearing NFTs or other things like that. So should we get partners with payment companies or ramps? we'll be looking at that. May not be necessary, but we'll be looking at it. OnRamp.money we talked to before, Cypher we talked to before, and then we also have one with Bit2Card, I think their name was, and they specifically just want to wait for us to have an off-ramp. So once we have an off-ramp, we're good with them.
Wow, lots of with things coming from your side. It's wild, like how many different problems you're tackling at the same time. And you mentioned yield-bearing NFTs, and I know that like in the past we were talking, or like there were some rumors of Symphony launching their own NFT collection similar to Mantra or Union with Omis and whale sharks. So yeah, can you share some alpha there, or is this still on your roadmap? And yeah, what about yield-bearing NFTs? Very interesting concept.
One thing before that, I missed this part of the question just before. With regards to our launch, that's going to be happening. That's going to be happening in the next week, either at the start of the week or at the end of the week. That part is not planned, but it is going to be happening next week. We wanted to wait for the wallet to be done because the stablecoin staking access has not yet gone into the wallet. That's not finalized yet, but we are going to have a period of time before the staking goes live on the mainnet. So we'll still have time to get that in, and it's not going to take 3 weeks. It's going to take like 1. It's very easy to get in. You just connect to the API. So there's that. We're going to have mainnet up very, very quickly, and then it's just going to be connecting to everything. But on the NFTs, the reason why we want to connect to NFT groups and make their sets yield bearing is because that does 2 things for us. 1, it allows us to get additional validators, and 2, it allows us to incentivize total value locked. So in return, we are helping sell their NFTs, because if they're yield bearing, if people can make money off those, it's like, why would you not buy something that makes you money? But in return, what we get is we get additional look at our stablecoins, because if they are denominating in one of our stablecoins, then that incentivizes use. And then holding their NFTs, like partnering with the NFT group to do that, that allows us to incentivize total value locked. So being able to do that would work very, very well for us, and even better than having our own NFT. Now, we do still want to have our own. We still want to have multiple of those. But since it takes 2 to 3 months to make each of those, and we want to get out onto market so we can compete with groups like USDC, USDT, Athena, and others, we have to get out sooner, so we can't really do that right now. We do still want to do it. We do still want to get that out, but that is something where, due to the time constraints on it, we cannot do that yet. Anyone that wants to come on and wants to earn a coin allocation for making those, absolutely, you're welcome to do it. We'll help you do it, and you can take the absolute majority of those profits if you want to. just help us make it yield bearing. But it's not something that we can do right now because we have to focus on the app development and getting everything out and making sure that we get it out very quickly so we can compete with these other groups who are starting to figure out that all the things that we do are good. Like yield, they figured that one out. Gas compatibility, they figured out that one out recently, and they're starting to look at local currencies. And we want to make sure that we get that out specifically before anyone else does.
Wow, yeah, lots of things cooking. So you're not only innovating on the stablecoin side of things, but also on the NFT side of things. And I think, yeah, there might be some decent product market fit if you can turn existing NFT communities or like turn their holdings into a yield-bearing NFTs. I think, yeah, that's a very novel approach and super excited about that. I mean, I'm a big NFT fan and hold several bad kits, like all the Cosmos blue chips. So yeah, hit us up whenever there are any news on your site. So curious to play around or like use my NFTs as collateral to earn some yield potentially on top of it. And yeah, thanks again for jumping on. Is there anything that we missed that you wanted to share with us, like some final thoughts?
Well, I did mention this a few times before, but there is another aspect I can go into on it. Now, we aren't just making a chain. We're also making an ecosystem. We're going to be connecting to different ramps, payment providers. We're going to be building out apps. We're going to be building out all these different cases that either people had talked about before and never made, or people hadn't talked about and people hadn't considered. We want to be able to get a lot of different things onto the chain, and I've got two different groups that are going into those. The main sticking points though are on funding, and that requires having people who had raised before, who had previous successful exits, or have a great deal of experience in the space. I'm an AI guy, so they look at me and they don't think blockchain developer, even though like I was able to make all this. So like my credentials relate to AI. I've been able to talk. I've gotten a meeting earlier today, and then I also have a meeting on Monday with people who had worked at Nexo and at Revolut, and those should they go well will allow us to bring on people for the neobank team. Should anyone have any interest in what we were talking about though, and want to join our teams for one of the things that we're building out, where they have ideas for what to build for what they want to build out themselves, we're willing to help in any way we can. Whether that's starting up a new team, getting that funded, and getting that developed so that way we can get it out the door and start making money, or if that's getting you a chain allocation to build an app onto the chain and start getting additional use cases in there, or making NFT sets yield bearing. Anything that helps us build out the ecosystem, we're on board for. And we do have a lot of plans for how to build out the ecosystem. That roadmap goes a long way.
Yeah, beautiful final words. So if people are interested or want to contribute to Symphony, how can they reach out to you, to the team? Where can they find you?
Well, I'm in the Discord. I'm also in Telegram and Twitter. The best places because of the testnet are the Discord and the Twitter. Since most of the announcements went over those two avenues, and the testnet was managed through the Discord, that's where most of the people are. Granted, most of them are in the language channels. Like we have a 40% Indonesian user base. Now, I'm going to be available in those two places. Now, you can contact the official. You can contact my account, or you can contact us in the Discord and ask for Obsidian. Like literally, my name is David Blackstone, so go buy Obsidian. It's literally just me. Yeah, one guy actually pointed that out. I was like, hey, wait, so it's just your name? I was like, yeah, it's just my name. Yeah, you can contact me on Twitter, either at my account or the official account, or you can contact me in the Discord. Those are the best places. I'm also in Telegram, but until we build that out more fully, you're going to find more action within either of those two areas.
Yeah, perfect. We will also link all these channels up in the show notes. And once again, thanks a lot, David, for jumping on this call with us here. And yeah, best of luck for the mainnet launch, which is just around the corner next week. We will definitely keep an eye on it. And yeah, eager to try it out in full production. Thanks again. And yeah, enjoy the rest of your day.
Thank you. You as well.
Bye.